So let's continue with the basics of price action analysis, beginner series 205. Let's choose the laser point. So you should understand the basics of the Dow theory or the phases of the Dow theory. In the Dow theory, the theory is that the market has three trends. So it has a primary, a secondary, and a minor trend. So long-term, mid-term, and short-term fluctuations. Trends have in general three phases. It has accumulation, it has public participation, and it has distribution. And all market information is represented in the current price. The creator of this beautiful theory is Charles Dow, beautiful, beautiful man. And he thinks that markets in general tend to move in trends, and those trends are confirmed by volume. And the trends persist until there is a clear sign of reversal. So you have uptrends, you have consolidations, and you have downtrends. In the Dow theory, a trend shift signals a potential change in the overall market direction, but you should always watch out for a confirmation. And the confirmation is not just the lower low, the confirmation is the break of the lower low. So the failure of a lower or higher high, because you can also make a lower low but still make a higher high. You always should wait for a confirmation when identifying trend shifts. Furthermore, there is a Wyckoff logic, which is kind of Dow theory on steroids, a little bit adapted and more advanced. So there's Richard D. Wyckoff, also a very beautiful man, but without a beard. And it focuses also on price action and also volume, but aiming to align this with institutional interests. So it's about supply and demand and shifts in price. The composite operator, which is like the big wealthy participants that influence the market, have a way bigger role in this theory, and there are four phases, not three. And furthermore, there is effort versus result, so there is always price and volume, but it's more a combination of both. The Wyckoff cycles are kind of the same, but a little bit more complex. The Dow theory focuses more on market trends and that all information is represented in the price, and the Wyckoff logic in addition focuses more on supply and demand and has an addition like a spring. So you don't only have accumulation, you also have like an extreme point or an extreme point in a balance, like a fake breakout. They call it spring, or have different terms for this, but it is not more than like a fake breakout in an accumulation phase. And the Wyckoff theory focuses more on the logic of the smart money, like what's the interest of the smart money, how do they move the markets, how can they cheaply accumulate without moving the markets. And in the theory, big institutions accumulate in phases or fair value phases or balances, and then the public steps into the market moves, and then they scale out or continues to scale in. But the theory is that the big market participants are most active in the balance phases. So also there you have accumulation, markup, reaccumulation, markup, distribution with the spring, and then a mark down and redistribution, and again a mark down. And furthermore, there is the auction market theory, and that is about that markets are created to facilitate trading and make it easy for participants to find liquidity. So your interest as a market participant is to find liquidity. You want to buy or sell at the best price in the fastest possible way there is. And markets, especially for big participants, look for areas to trade comfortably without getting slipped or getting slippage and affecting the price. A big market participant has no interest in moving the price, because the more he moves the price, the worse the price is that he gets, either for buying or selling. So they want to stay undercover and don't want to move the market. And that's most easy in fair value, where a lot of market participants are agreeing to trade. So if something happens, market can go out of balance because fundamental shift or because the public runs into a meme coin, or public thinks, oh, now this is a stock I need to buy, and everybody's just buying, and the supply decreases and there are more bidders willing to pay a higher price. Since buyers or sellers are outnumbering each other, so that's why the price is moving. And short, or in a summary, this is the auction market theory. And at some point then the price discovery begins, so the market is searching for fair value. So for a time he is in a fair value range, and then there is a shift in endogenous or exogenous factors. So you have a change in perceived value of the underlying asset, and then there's price discovery until there's again a fair value, where then an accumulation starts where people agree to trade on that price. So there is the auction market theory, or the theory of auction markets. So in the definition you have phases where there is a state where supply and demand are equal, so there are stable prices, there is a fair value, there is a balance. So limited volatility, and most of the times you have a consolidation, you have horizontal support and resistances. Then there is the phase of price discovery or imbalance. So you have increased volatility, you have very strong price trends or breakouts, and traders capitalize through imbalances and trade the breakout or momentum. At some point there's going to be fair value again, because market participants agree on the price, and there's going to be price discovery again. This is the logic behind that, and this is what a volume profile in this case could look like. Most volume is spent in the balance or fair value phases, because here it is price discovery and not that much volumes traded, because there is a shift of way more supply, like in this case, or way more demand, like in this case. Now please continue to the proficiency test for Beginner Series 200. So you test if you really understood the things that we told you, or you need to give some lessons a second watch, and otherwise we will see you, or you will see me again in Beginner Series 300, where we more and more will dive deep into analyzing volume and how to use the volume profile to analyze an asset and trade based on that.